Mm, Assalamu alaikum dear students. So today our topic is regarding to the foreign exchange market. As we discussed before about the foreign exchange market. So in this lecture I will give a goes through touch to the foreign exchange market. Foreign exchange market. Before going to discuss the foreign exchange market, I should explain the exchange rate because exchange rate is a main factor that are used in the forex market. Exchange rate is that rate at which one country currency that are convertible into another one country currency, or exchange rate is the price of one country currency in terms of another one country currency. So that rate is called exchange rate. For example, nowadays if we looked out the exchange rate of the dollar with Afghani, so $1 that is equals to 77 Afghani. And it means if we want to convert $1 to Afghanis, so we will get 77 instead Afghani instead of $1. So that conversion rate or that ratio 1:77, that is called exchange rate. Foreign exchange market, or this is also called forex market. So that is a financial market where funds are converted from one currency to another one currency, or it is a mechanism of the exchanging one currency with another one currency. That market where one country currency is converted to another one country currency, so that is called what? That is called forex market or forex or foreign exchange market. It is a for the large market in the world in terms of cash value traded. So due to the high volume of the trading, it is also called a unique market. Each and every country have this market. Like in Afghanistan, Sarai Shahzada. So if you have any kind of the currency you need, so you can convert that currency to another one currency. It's include the trading between the large banks, central banks, currency speculators, multinational corporations, governments, other financial markets and institutions, as well as like when the banks needs some types of currency, so they can also convert their local currency to the foreign currency. Central bank, if they need, so they can also convert their domestic currency to the foreign currency. Speculators are also, multinational corporations also need of the different types of the currency, so they are using this market. This market is called a unique market. Why? Uniqueness is in the sense of their trading volume. Daily wise, a huge amount of the funds that are converted from one country currency to another one country currency. So due to this, we can say that this is a unique market. Another one, the extreme liquidity of the market. Forex exchange market is extremely liquid because it is already in the shape of the money, and money shape is also a liquid form. So if we convert one country currency to another one currency, automatically, easily, without no hesitation, without no wasting the time, we can convert one country currency to another one country currency. So that's why, due to this property, that they have the high liquid, extreme liquidity property this market have. Other market are not too much liquid as the forex markets. So this due to this high liquidity property, it's create their uniquenesses. Third one point of the uniquenesses of this market is the large number and variety of the traders in the market. Large number of the huge numbers are involved in this market, and variety of the traders in the market. Variety of the trader means different types of the traders, either that is individual, that is firms, that is governments, as well as I discussed before, that multinational corporation is also taking part in the forex market because they need the different types of the money. Similarly, government is also take a part, central banks, commercial banks. So all the other financial institutions as well as individual people is also taking part in this market, like me and you peoples. So this is also create the uniquenesses of this market. The fourth one part is their geographical dispersion. Each and every country, they have this market. So it means that this market is spread all over the world. In every country, the exchange took place. So when the exchange took place, so the same nature of the business that is dispersed all over the world. That's why this is a huge market in all over in the world, as well as its long trading hours. Long trading hours means that, look at those countries where the trading hours are off, but some other countries over there the trading or working hours are start. So 24 hours the operation of the foreign exchange market that are continue. Like look at, here is now day, so there is night in the United States. So over there the forex market activities are closed, but here is a start. So similarly, this is a continuous process because this market consists of all over the world. That's why their trading hours are too much long. Then the variety of the factors that affects the exchange rate. Look at, we are saying that nowadays we are saying that $1 is equals to 77 Afghani. So this exchange rate is what? That is affected by the following factors. Sometimes $1 becomes 75, sometimes they are become 74, then they are jumping up to 76. So this exchange rate depends upon the following factors. Number one, interest rate. When the interest rate are increasing due to inflation, clear? So the exchange rate will also be increasing. Those countries where there is an increase in the interest rate, so the exchange rate will also be increased. One factor that are affecting the exchange rate is interest rate. And when the interest rate are controlled by government and they are decreasing, so the exchange rate will also be decrease. Second one, factors that are affecting the exchange rate is import and exports. Those countries whose imports are more and export are less, so they are keeping the exchange rate high. when the imports of the countries are high, more, and export are less, so those countries are keeping the exchange rate low, less. Like Afghanistan, if we compare the Afghanistan with the Iran, with the China. So here, this is an import country, so they will keep their exchange rate tight. And those country who keep their exports are more than imports, so their exchange rate are high. Clear? Why? In this sense, that when they are importing the goods, so they will pay less, and when they are the exporter country will keep, in that sense, that they keeping their exchange rate value, they keeping the value of their currency what's higher, for the sense that they should encourage the exports. Next one is demand and supply of currency. If demand of the currency is high and supply is low, so the exchange rate will become higher. Why? Because those persons who need of it, they will buy those currency at a higher price. And if the demand is less and supply is more, so in that situation, the value of the currency will be devalued. So again, prices will be high. The fifth one is inflation. Inflation is also affect the exchange rate. Those countries where the inflation is controlled, so the exchange rate is also stable against the dollar, international currency. But those countries where the inflation is uncontrollable, so inflation directly affects the exchange rate. High inflation rate will lead high exchange rate, and lower exchange rate will lead low inflation rate will lead low exchange rate. Government is also effects on the exchange rate. Sometimes the government policy is to restrict the exchange rate, and sometimes the governments by itself increasing the exchange rate. Mostly keep in mind the exporters countries, they are keeping their exchange rate higher, and importers country, they are keeping their exchange rate lower. Like China. China is financially too much strong. But if you compare Chinese yuan with the dollar, so their value is too much devalued. Why? Because China is exporter country, so they keep their exchange rate lower. Next one topic is market participants or Forex market participant. Whose will take part in the Forex market? So, banks and central banks, because they need different types of the currency, so they will take parts in the Forex market. Then corporation and multinational companies, they also engaged in the buying and selling of the goods in different countries. So they are trading in those countries' currency. They need of those currency, so they are giving one country currency to another one and convert them. They are become the participants of the Forex market. Speculators. Speculators are also called risky investors. Like I'm speculating that in upcoming week the dollar rate will be high as compared to Afghani. So now I purchase dollars. So I'm a speculator now at a higher rate. So when I give the Afghani and purchase the dollar, so where I should convert this currency? Automatically in the forex market. Then foreign exchange dealers. These dealers, they are trading in the different types of currencies. So they are a part of the forex market. Then individual person is also a part of the participant, like me and you people. We need dollar, we give Afghani and purchase the dollar. We need euro, we give Afghani and purchase the euro, and so on. Now comes towards the level in the forex market. So there are 3 levels in the forex market: level 1, level 2 and level 3. Level 1 transaction are one national market where dealer banks buy and sell with the customers. In the national market, the dealer bank buy the foreign currency and then sold out to customer. So one side is bank and another one side is the different customer of the bank. So this type of the forex market, that is called level 1 market. Level 2 market, transaction are in one national market where 2 dealers bank deals with one another. When banks to banks, they are taking place in the national market, the exchanging of currency. So that type of the forex market is called what? Level 2 forex market. Level 3 forex market is when the transaction between 2 or more national markets where dealer banks in different centers trade with each other. So here is the national market and more dealers and banks, and they deals in the different center trades or in the different trade centers within that country taken place. So this type of the forex market is called level 3 forex market. In the total words, there are 200 currencies. So 200 multiplied by 200, there is 40,000 combination of currency. Like we can convert Afghanis to dollar, Afghani to euro, Afghani to pound, and so each and every currency there are 200 combination with each country. So total combination of these 200 currency is 40,000. The history of the forex market, that is started from the gold standards, then to the fixed exchange rate, Bretton Woods models, and now we have the free floating regime or rules. Types of the forex market: spot market, forward market and future market. Spot market is that market where on the spot the exchange rate is fixed. Like nowadays, today if I go to the Sarai Shahzada and I compare that what is the exchange rate of dollar with the AFS, so that is called spot rate. Forward rate is what? Forward rate, that we are fixing the rate for the future activity. But this is non-organized, that should take place between 2 parties. There is no involvement of the third parties. Like today, me and you people, we are fixing the exchange rate, that let's suppose I will make payments, taking a credit transaction with each other, and I say that I will make a payment on 77.10 after 10 days. So after 10 days, what will be the exchange rate of the dollar? I will make payments to you on 77.10. This is called forward market. Future market, that is a standardized market. Here clearing house, third parties is involved by the name of clearing house, and they are providing some instrument, and on those legal documentation the transaction taken place between the two parties. Like if me and you people are engaged in a credit transaction and we are fixing the exchange rate for the future payments, so we will go to the clearing house, over there we are sign a agreements. So this type of the market where the future where the exchange rate are fixing for the future, that and through by a standardized way, so that market is called future market. Relating to the forex market, there are different theories like purchasing power parity theory, interest rate parity theory, and international Fisher theories. Purchasing power parity theory is the theory where the purchasing power they tend upon the purchasing power equality, that the purchasing power of each and every person that should be equal. Like look at, if we buy a goods here in Afghanistan on 100 UFs, so the same goods should not be the same price $100 in the United States. No, maybe their price will be $2, yeah, $1.80, $1.80. Similarly, the interest rate parity. Interest rate parity you will discuss in the detail, but here I am giving you a touch. Like if in Afghanistan the deposit interest rate is 10%, so in the United States the same 10% rate should not be over there. Interest rate parity says that let's suppose 10% is here, yeah, 7% is here, let's suppose. So in the United States, on the basis of the currency exchange, that will be 0.11%. So in both the country the interest rate will be equal. International Fisher theory. Fisher was the United States economist, mathematical economist, and he provides the different theories. And one theory he gave that on the basis of that theory we can finding out the future spot rate. Is formula for that is that the future spot rate divided by spot rate is equals to domestic currency interest rate and divided by foreign currency interest rate. So he provides this theory, and on the basis of that theory we can finding out the future spot rate. So these theories are related to the forex market. So hope you will understand the concept of the forex exchange market or forex market and their main idea that will comes to you. Now if you have any question, so you can ask me.